My name is Tabitha, and today we are going to talk about economics concept to stock market investing and trading. So, what are some of the concepts that people use from economics that make them profitable in the stock market? Okay, let me show you some. So, those concepts, we are going to look at them today, and they are going to come from both micro and macroeconomics. So what is part of the economics that is applied to finance and especially stock market. So let's look at them. So if you're new to this channel, please subscribe for more videos and I will appreciate your support. So let's look at the agendas of today. So some of the agendas are different between macro and macroeconomic. So sometime before you get into the real topic, you need to understand what you are really dealing with. So some of these definitions are obvious, and some of us who have been to business class, we are familiar with them. And from there, we can drive now lesson that we get from these two and how we can apply them in the stock market. Topic under microeconomics and macroeconomics, how to apply this economic concept on investing portfolio. So that is, these are the agendas of today. So we look at them one by one. So one is like this, what are these differences between the micro and macroeconomics? So I'm going to put them separately because like it's the long notes, and if we have to put them side by side, it's going to be like all clouded. So microeconomics is the study of small economics units. So it's just like a small part. It take care of the individual, it take care of the firms, and then it also take care of industries, individual industries. As unlike the macroeconomic, which look at the whole system, like you look at the whole country, look at maybe the whole region. So this is different. Okay, so microeconomics explain what happened when there are changes in a certain condition. So let's say, for example, a firm want to produce a product and there is maybe external factors or internal factors that change, that affect the way they produce that product. So how company could maximize its production and capacity so that it could lower prices and better compete. So those are some of them, like maximizing the production. How will they really get the labor? How much will it cost them to pay those workers so they can produce that good? How much are they going to sell those goods? So those are the things that microeconomics handles. So more on the topic of microeconomics. So what are some more points that explained what microeconomic does and which could be opposite of what macroeconomic does? Supply and demand are the forces that determine price level, make it bottom up approach. So this demand and supply things, and mostly on the micro level, it shows that the system is being built from the bottom up. So it's more focused on individuals. So when individual like build things, produce good for themselves, sell those goods, they become powerful, and then all those individuals add up, all individuals industries add up. So those one now will build the whole nation, right? So the system of microeconomics, or the way it look at it, is like it's bottom up. So it has the focus on individual farm, individual people, individual personal finance, and all those stuff. And then this will sum up and build the whole unit, which make it a whole economy. Now let's look at how other people approach it from the other angle. So we are looking at microeconomics. me personally, I like the microeconomics because you have control over what you can do as individual, and then maybe the government can influence. But if individual can produce your stuff and do this, and then the whole economy can really grow. Macroeconomics, on the other hand, is the study. It studies the behavior of country and how its policies impact the economy as a whole. So it's like the government or maybe the whole country. It studied the how policies are made. Maybe policies are made by the government, and then these policies affect individual companies, individuals, and then that's really bring all about the economy as a whole. It analyzes entire industries and economies rather than individual or specific companies, which is why it is top down. So it has to be like stable from the top before it really good at the bottom. So there are some continent or some countries that operate like that. So if the country or the political side of the country is not really stable, and then individual cannot really operate very well. But mixed economy have both sides of macroeconomics and microeconomics applied. Macroeconomics. So we are on this topic again. We have already defined that it's the study of a whole economy, the whole economy, like countries. Macroeconomic study of the large economy as a whole or economic aggregates. So that's how it is. So it's like a repetition, okay? So macroeconomic studies is the study of the large economy as a whole or economic aggregate. Macroeconomic take top, bottom approach and look at the economy as a whole, trying to determine its cause and the nature. So how does this really affect individual and individual companies? So that's what it is. Economics and macroeconomics. So we have already seen the difference. So the micro take into account the individual and the individual farms. The other one is taking care of the economy as a whole. So the other one, the microeconomic is bottom up. The macroeconomic is the top down. So that's how they are different. And then they are interdependent and complement one another. So it's like microeconomic cannot operate without macroeconomic. So if the whole system is not functioning very well, individual farms might not really operate really well. And then also macroeconomic, if individuals are not performing very well, so we might not get a great whole economy. Like the GDPs are affected by individual performance, individual companies, consumer. So all those things, they're all interdependent and they complement each other. The next part is, now let's look at microeconomic topics. Some of these topics, we are very familiar with them. Demand and supply, the equilibrium. And this is the topic that is actually applied in the stock market. So how do you look for demand and supply in the stock market where there is no equilibrium? And how does that really affect the stock price? Prices are determined by the law of demand and supply, right? So when we are at equilibrium is when the demand and supply are equal. When there is this equilibrium, or is that discrepancy where there is more demand than the supply, or there is more supply than the demand, and then the price can move up and down. Okay, they say, for example, we have more demand, less supply, the prices will go up. If we have more supply, less demand, the prices are going to go down because they will have to sell the product anyway. So they will decide to maybe reduce the price so people can buy them. In perfectly competitive market, suppliers offer the same price demanded by consumers. This creates economic equilibrium. So this is where demand and supplies are equal. It is a condition that is never there because sometimes demand does not equal the supply. It could be either way. Supply is more, no demand. More demand, no supply. So microeconomic topic, production theory is the study of how goods and services are created or manufactured. So most of the time we have that like production frontier, like the one that they use to compare the resources that the company has versus like how much they can produce, trying to study the potential of that company. Okay, so this is how and what happened when there is like a change in any factor. Let's say there's more technology. So if there's more technology, so which point will the company produce their goods and services? So that what it is. And the next one would be cost of production. According to this theory, the price of goods or services is determined by the cost of the resources used during production. So this is self-explanatory. And so cost of production is always determine the price of good. So if you spend more resources on producing this good, you might end up pricing it high so you can really get something out of it, right? So the cheaper the resources or the less you use when you are producing, the more profit you might make. The labor economics. So labor economy, this look at the workers, employers, and try to understand the pattern of wages, employment, and income. So that one also take care of that. So in terms of how can this one apply, it's affect individual companies. So if individual companies have been affected, the earnings might be affected, and this will transfer into how much is their stock price. Okay, microeconomic topic. The rule in microeconomic flow from a set of compatible laws and theories rather than beginning with empirical studies. Yes, comparable. This look at workers and employers and try to understand the pattern of wage. So this one also apply to the labor economy. So the difference here is like more macroeconomic, look at the empirical studies, and more of the microeconomics. They look at the compatible law and the theories of individual companies. Macroeconomics, it answers the question such as what should be rate of inflation. So if you look at this this slide, you will tell what are some of the topics like inflation, GDP, and what stimulate the economic growth. Now let's look more into macroeconomics topic, and we'll look at this. Examine economy wide phenomena such as gross domestic product, which is GDP. this is how many economic growth are measured. They are measured using the GDP and see how the country is performing. Some countries will be labeled as middle income and the high income and the lower income countries. So GDP is one of the topic of macroeconomics, how it is affected by changes in unemployment, national income rate, growth, and price level. So all this one apply to the GDP. So how does the GDP works when there is unemployment? So does it really affect it, national income rate or growth, price level of the product? So there are different ways that they calculate like GDP, maybe even consumer good, they also use it, or maybe they use companies, they use employment, they use different things to calculate GDP. Macroeconomic analyze how an increase or decrease in a net export impact a national capital account. So that's another one too. When we are doing macroeconomic, we can also talk about export, the country's export, the country import. What are some of the things that the country should not import because they already produce them? What are some of the things that the country should export because they have the comparative advantage of sending them to other countries and still have something for themselves? How gross domestic product is impacted by the unemployment rate. So all those topics fall under macroeconomics. Forces on aggregates and economics correlation, which is why government and the agencies rely on macroeconomic to formulate economics and fiscal policies. So that's what it is all about. Macroeconomics is for the whole system. Investors who buy interest rate sensitive securities should keep close eye on monetary and fiscal policies. So this is so true because like when the economy is really trying to fall, there is an intervention that need to be done by the government so that they really keep everything afloat so that it doesn't crash. Let's say, for example, in 2020, there was a market crash, and then that was also corrected by government manufacturing more money, they induce money into the system, so which really stimulate investors, macroeconomics and microeconomics. So how do investors benefit from macroeconomics and macroeconomics in their activities? Individual investors may be better off focusing on microeconomics. Yes, but at the same time, they should not also not look at the bigger picture, which is the macroeconomics. So the monetary and physical score policies, they also affect the stock market, right? So even if we need to focus on microeconomics, what is going on with the company, what is going on with my personal finance, where do I get the money to invest, and if I put them in this company, are they going to survive or am I going to get the profit? So those stuff. Fundamental and value investors may disagree with the technical investors about the proper role of economics analysis. Consider macroeconomics. So these people, the one who are value investors, the one who maybe invest in the companies that they believe in, and they will keep that money so they can add value in the future. Those one look at both macro and microeconomics. Long-term investors don't look at macroeconomic because economic factors will change. They change with time. So I think I missed something there. They change with time. They don't look so much into that. Value investors. How does this one really apply now is that the value investors, they don't look at whether the stock is going to go up or down, but look at the value stocks. So these people will buy it and hold it for long term. So they buy low and sell high. So once the value is when the stock is devalued, they buy it, hold it, and sell it when it's really increased in value. So for example, like I said before, Great Recession of 2008 to 2009, it was accompanied by market crash. So it was caused by this US housing bubble, and subsequently they almost collapse, right? Because some of these financial institutions that were heavily invested in US subprime mortgages. So this one, because it was the housing bubble that caused all that problem. So how did the macroeconomic correct it? How did the macroeconomic correct it? Correct it. Macroeconomic, like monetary side and the fiscal policies, they always intervene in the market. So this is where the macroeconomic is very important to control the whole economy. So it's that study of the whole economy. So like say, for example, the response of the central bank and the government to the pandemic-induced crash in 2020. So you are in the market in 2020, you will understand what actually happened. So most of the good companies end up being devalued, and what the government had to do was to liquidate the market by printing more money. So putting it there, the physical and monetary stimulants increase the economies and reduce recession, and pushing those major equity market to record highs in the second half of 2020 and throughout March of 2021. So if I explain the second part is that once the market was induced, right? They induced liquidity into that market. And because of that, it reduced the recession. And when the recession was reduced, this one also stimulate equities companies to grow. So when they grow, they record heights. So their stock price increase. So like for example, BMO went to 71, and then after the liquidity was induced into the market, the price went back to 140. Microeconomic concept affect stock price. The disequilibrium on the stock price. So once you're there and you see there's disequilibrium on stock price, demand exceeds supply, more buyers than the sellers. If you look at them and you see demand exceeds supply, that is the point. The stock price will rise. Supply exceed demand, more sellers than the buyers, and the stock price will fall. So how do you look at the demand? So the demand, if people who are willing to buy the stocks are more than the one who are selling the stocks, and then that's where you have the demand exceeding supply, and the vice versa. supply and demand. If companies' products are flying off the shelf because of the more demand, then increase the earning and stock price will also increase. So that one is also when you're looking at the fundamental of the company. So do they make more sales, right? So that one also makes sense. And then you look at that. But if demand is low and there is excess inventory or supply of each product, the company earnings may decrease and the stock price may decrease. So this is in terms of the goods and services as opposed to the stocks being sold. Thank you for watching. This is the end of the video and I will see you next time.